Okay, I think the recording's begun. So what we're going to look at today is part two of financial foundations. Now, we started this topic last week. So for those of you who were here last week, you may remember that we did an Excel demo going over some of the different valuation methods of different projects, going over weighted average cost of capital, um, what else? Net present value, payback period, all those different ways of finding out which project is more or less profitable than the other. Or, if you're comparing more than two, which is the most profitable, which has the lowest payback period, meaning you recoup your investment faster, and just which projects are more valuable. So you don't just look at those raw numbers, you look at all those measures that are equal from one project to another, and then you essentially compare them. So now we're going to be talking about short-term management or working capital management here. We're just going to touch on it just a little bit. So short-term financial management is something that you're definitely going to hear a lot about within the field of finance. Some other, ways of saying short-term financial management or some other phrases that are commonly associated with it are treasury management and working capital management. There's actually a really good course that's taught at RBS. It's a little on the difficult side. I'm actually taking it right now. It's called Treasury Management. I'm taking it with Professor Ron Richter. Highly recommend. It's a great course. You actually learn a lot about working capital management. So yeah, highly recommend you take it. So I'm just going to be going over some of the accounting and treasury related material or concepts that we're going to be taking a look at. That's also important to FP&A because what happens in short-term finance? Okay, thank you for muting yourself. So what happens in short-term financial management, which is inventory, accounts receivable, accounts payable, your goods sold, raw materials, all that kind of stuff, that plays a huge part in forecasting and financial planning because, if any of those measures go drastically up or down, it could greatly determine or impact, I should say, our forecasts. Yeah, Anna, I completely agree. He's a great professor. He's actually one of my favorites at RBS. Professor Richter, highly recommend you take him for treasury and any other classes. I think he also teaches financial management. Okay, so going back to the topic, short-term financial management or treasury. So it involves managing a firm's finances within the time frame, generally of one fiscal year, because when you're looking at treasury, you're thinking of how many times you're collecting, receivables, how many times you're paying your suppliers, basically how many times you're going through the cash conversion cycle of paying, not paying, collecting materials, selling those materials, collecting receivables, paying payables, all that kind of stuff. Basically, getting the goods, making the finished product, and selling it to your customer. And that usually happens, it should happen more than once within one fiscal year. That's what's called the cash conversion cycle. Usually with other types of goods that are a little idiosyncratic, that may take longer than a year. Those big projects, maybe like plant and factory creation and stuff like that, if there are firms that specialize in that, those are special cases. But usually for businesses, like a cake shop, the purchasing of the raw materials that go into the cake, the creation of the cake, the inventorying of those materials, and then selling the cake and collecting receivables from your customers while paying payables to your suppliers who give you those raw materials. That happens multiple times. Well, in the case of a cake shop, it happens multiple times in a month, not in a year. It happens, I would say, dozens of times in a year because it's a food-related product, and food usually it doesn't last in your inventory for that long, even if it's raw materials. So that's what we're going to be taking a look at. What finances can be managed within the time frame of 1 year. Budgeting for and maintaining the financial health in an upcoming fiscal period is key for long-term success and must be planned accurately. So in terms of short-term finances that should be managed in the short term for long-term success, like I said before, some of the stuff that we're going to be discussing are receivables and payables, as well as how to account for them, inventory, and the accounting related to that. SG&A is known as selling, general, and administrative. This is, your cash and non-cash expenses that are fixed. also known as your overhead. This is where depreciation of plant and property and other capital expenditures, that's where that occurs. Amortization of loans, wages and salaries payable, other types of fixed accounts payable, basically your fixed costs that act as overhead, that are not reliant on what you sell or how much you sell, or sorry, how much you sell. It's pretty much set in stone. And cost of goods sold, which is a variable cost because it directly relates to the cost of the exact amount of goods that you sell. That's usually the second line item in an income statement, and we'll be taking a look at that today when we do our Excel demo. So income statements, as we've gone through the past couple of weeks, they consist of yearly performance by revenues and costs to a firm. That's why you start with revenues, go to cost of goods sold, then you go to your fixed costs, which is SG&A, then taxes and interest, and you end up with net income. And even after that, there is a section for retained earnings. If you pay anything out in dividends, that's usually a statement of retained earnings, but it can be put in the income statement sometimes. So these results within the income statement, they measure a firm's financial performance in the short run. And they can also be used to compare a firm's performance by year and by industry as well. So if I'm in the soda industry, and let's say I'm Coke, for my 2021 income statement, which did come out a couple of days ago, I think a couple of weeks ago, I can take that income statement and find, okay, what's my COGS margin? How much of my revenues is going to cost of goods sold? How much of my fixed costs, or SG&A, is going towards my, how much of my revenues is going towards my cost of goods sold? How much of my revenues is going towards my fixed costs, or SG&A? How much of it is going towards taxes and interest, and so on and so forth. And finally, these results can impact a firm's ability to generate proper cash flow and reflect it in their valuation, while also potentially crashing investor expectations if not managed well. Now, margins are only as good as the context that they're provided in. So if you tell me that an asset turnover ratio for a company is 1.5, that's fine. The only thing that's telling me is that, the asset turnover, which is revenues divided by total assets, it's 1.5. So the numerator is greater than the denominator. The revenues beat the assets. That can mean something that's good if, in comparison, other firms within the industry have an average asset turnover of 0.9, in which case this firm with a 1.5 asset turnover ratio, they're getting rid of their inventory quicker. They're selling stuff faster. But it could also mean a really bad thing if the average industry asset turnover rate is 3. It means you're not getting your materials out. You're not selling stuff as quickly as your competition. So these measures are great in terms of being calculated easily. You can just look at the income statement and calculate it. But context is everything here. So take all of these numbers that you see in the income statement with a grain of salt, and also compare them to other firms to see if they're actually good or if they're bad, or if they don't really mean much at all, if they're the same throughout the industry standard. If they're not managed well, then it can result in your stock dropping if you're a public company, and potentially people selling their equity in the company if your investors are not happy with the way your company is headed or the direction that your company is headed. So that's the importance of short-term financial management. Usually it incorporates the cash conversion cycle of you receiving goods, turning those goods into finished products through your inventorying process, selling those finished goods to your customer, collecting receivables from customers, and paying payables to your suppliers. That is what the working capital short-term financial management kind of environment looks like. So it's small, but it's super duper important in the long run. So I was talking about the operating cycle and of cash management, otherwise known as the cash conversion cycle. So essentially what this is that entire cycle of getting raw materials up until the point where you pay your suppliers. Like you get stuff, you make stuff out of it, like finished goods, and then you sell that stuff, collect payments, and pay your suppliers. That entire cycle is one iteration of the cash conversion cycle. So it says over here, the cash conversion cycle is the number of days it takes to buy raw materials, make a product, sell it, collect payables from customers. And as a result, the equation of it, and I don't think this is in the quiz either, this is just for your future knowledge. It's days inventory outstanding plus days sales outstanding minus days payables outstanding. So days inventory outstanding, it means essentially how long is your stuff, are your materials sitting in inventory? If that number is too high, then that's not good because it could potentially lead to spoilage if you're dealing with food, for instance. And that means that you're not getting stuff made that frequently. You don't want stuff sitting in inventory for too long. It could get spoiled, it could get destroyed, it could get rusty, and it could lead to high inventory costs. You don't want to spend more on storage costs just to store stuff that you're never going to sell, or there's a very low chance of you selling. So you want days inventory outstanding to be low. Days sales outstanding or days receivables outstanding, there's a slight difference here. I'm going to go with days receivables, which is essentially how frequent or how quickly are you getting paid? So the higher the days receivables outstanding is, the longer it's taking for your customers to pay you. You want this number to be small as well. You want to get paid as quickly as possible so you have that cash. The quicker customers pay you, the more easily you have access to cash on hand. Because if it takes quicker, all you have is receivables. Now there are ways of selling, securitizing receivables for cash. It's actually a thing called factoring. It's like, okay, here is $100 worth of receivables. I might get them, I might not, but I'll sell it to you for $70 because I don't know if I'm going to get all of them, but I still might get most of them. So this is what I think I will get. I'll sell it to you. Give me $70 right now. That's called factoring, but it's still risky. Ideally, you want the full $100 as quickly as possible because you earned that money because you sold your customer that product, and you need that cash. You need all the cash you can get. So you want days receivables outstanding or days sales outstanding even to be low. And you want days payables outstanding to be high, but not too high. So let me explain. You want it to be high because days payables outstanding is how long it takes for you as the business owner or the business financial manager to how long it takes for you to pay your supplier. So what you want is you want to spend a good amount of time paying your supplier. Now you don't want to spend a whole lot of time because then your supplier is going to get mad and ask, hey, why am I not getting paid? Why aren't you getting me the money? I gave you the goods months ago. I need to get paid. You don't want that kind of situation to arise because you'll break that potential relationship, and it's going to be very hard to find another supplier, especially if word gets out that you're not paying on time. But you do want to extend it as much as possible so that you get the full value of what you receive from the suppliers. If they give you raw materials, you make it into the finished product and sell it. And then ideally you pay them so that you get the full value of what they give you and you don't spend that cash yet. So you'd want days payables to be high, but not too high. And let's look at the math a little bit here. Let's observe kind of what I said for each one of these points. Where's the text? Drop. Okay, yeah, here we go. So I said you want days inventory to be low. You don't want your stuff sitting in inventory for too long. You want your days receivables or days sales. Same thing as receivable. Well, not the same exact thing, but very similar. You want that to be low because you don't want to get paid too late. You want to get paid as soon as possible. And you want your days payables to be high, but not too high, relatively high, because you want to spend as much time as possible to pay off your suppliers so that you have access to cash. What does that mean? We want these first two numbers to be low and this next number to be high. So we essentially want this cash conversion rate or this cash conversion cycle to be low. Or in other words, we want it to be tight. We want it to be as tight as possible. We want to get materials, make a finished product, sell it off, and collect payments as quickly as possible within 1 year. We want to do it as many times as possible. Like for Walmart, for example, because they're a big box retailer, they go through this process in just a few days. Their spreads here are very tight. They get those materials and they sell it off very quickly. And in many cases, since they're retailers, they don't even need raw materials. They don't really inventory much of anything other than, finished goods from other companies. So their suppliers are other companies that they retail. So, for them, the cash conversion cycle like their days inventory, it doesn't consist of raw materials as much, it consists of finished goods, so they get it out quicker. But their goal is to essentially get paid as quickly as possible, which they do because a lot of people pay with credit card, and usually the terms on that you have to pay relatively quickly. And they also have significant leverage in paying their suppliers for the companies that give them their products. So their DPO is relatively high. That's why they have a very, very tight spread. And that's what you want as a company. You want as many cash conversion cycles, as many cycles as possible to create cash, because cash is super important. This is something you'll learn later in finance, especially in advanced corporate finance. Cash is king. Access to cash is the most important thing you can have in a company. If you don't have access to cash and something bad happens, you're toast. You know, cash will save you from any situation as long as you have enough. And this is a great way to make sure that you have cash as a business owner. Collect it as quickly as possible, pay it as late as possible, but not too late. You know, keep that relationship, keep your ethics and reputation, but try and minimize this cycle. It also helps regulate cash flow integrity to increase a company's valuation. Because the lower the cash conversion cycle is, the higher the valuation is, because the higher the income stream will be. That's pretty much what I wanted to go through. So it's either the time it takes from the purchase of inventory by a firm to collect payment, to collecting payments from buyers in the form of either cash or credit. And in this case, credit is receivables. When you pay with your credit card, that goes into receivables because you're not paying with cash. So that's some stuff about the cash conversion cycle, as well as DIO, DSO, or DRO minus DPO. Inventory and AR, we want down. Payables, we want up. And as a result, the CCC, we want pretty low overall. All right, I'm going to clear all of this. Okay. So if we go a little bit more into depth, I think I talked about this a little bit. Inventory, at the end of the day, what it is the goods a firm has in stock or in storage and in property with any sort of intrinsic value, usually sold to customers at a high percentage margin from the raw materials. So you obviously retail it at a higher price or sell it at a higher price generally than you would buy the raw materials at, to prevent loss of quality and functionality. And it can be used to minimize tax losses or maximize gross profit. This we'll talk about FIFO and LIFO in the next couple slides. I think it's in the next slide actually. Moving forward, we have receivables and payables, or accounts receivable and accounts payable. So these are cash inflows that have not yet been received, or outflows that have not yet been paid, or short-term debt in this case. So customers paying the firms on credit is a receivable until the credit card company pays the firm. So you pay the card company, whether it's Discover, Visa, MasterCard, Amex, anything, and then once they collect that, then they essentially pay the vendor. Sometimes it can be the other way around, as long as they believe that you have good enough credit that you will pay the card company. As well as decreasing receivables and payables, it strengthens a company's cash flows to an extent. So what I actually meant to say here was decreasing receivables and increasing payables. And we looked at this in the cash flow statement a couple of weeks ago. So receivables decrease and payables increase. It actually increases a firm's cash flows. Because when you're increasing your payables, you're taking longer to pay. That means you still have access to that cash. You haven't paid it out yet to your suppliers. But when you're when you're decreasing receivables, that means that you're collecting more of your receivables in the form of cash. More of it's being converted to cash. So stuff that money that you deserve, that you've earned, but you don't have yet, is being converted more and more into money that you have. Right? It does strengthen a firm's balance sheet as well, because payables are in liabilities, receivables are in assets. If any one of them is too overly balanced, it could bode badly, especially if it's very high receivables. So you got to manage it. That's what finance is. It's kind of like a tightrope walk. You want to pay later, and you want the payables to go up a little bit so that you have access to cash, but you don't want it to be so high that your reputation gets, it basically goes down the drain with your suppliers, and you don't want it to the point where you have so many payables that you're knee deep in debt. You have like a 60, 70, 80% leverage ratio that you can't get out of. You got to manage your balance sheet while also managing your short-term working capital. So you don't want super low receivables or super high receivables, and you don't want super high payables, and you also don't want super low payables. You kind of want to take your time paying off your suppliers because it will help you as a company. And finally, cost of goods sold. This is subtracted from revenues in the income statement to create gross profit. That's the third line in an income statement. So these are goods sold from a firm's inventory, only the ones that are sold. So if it hasn't sold, it's still sitting there in inventory, it does not count in COGS. That goes back into inventory and it gets accounted for in the balance sheet, not in the income statement, because we haven't made any income from it. It might be a finished good, but we didn't sell it. So we didn't make any income from it. So cost of goods sold is purely variable. It depends on how much or how many units of your goods or products that you are selling. And it's the second thing usually on a firm's income statement. All right, now we'll go into FIFO and LIFO a little bit. So FIFO means first in, first out. What this means in terms of your inventory is that you put the products that were the first in, or the oldest, and they spent the longest time in your inventory, you put it in stock first. So that's the stuff that you put out on the shelves first. You try to sell that quicker than the stuff that got brought in later. So this leaves you with the latest products in inventory. What this means is because of the time value of money, because of inflation, because of rising costs over time, these factors all play into inventory costs rising over time. Inventory for plastic bottles 50 years ago, or even 10 years ago, really, were way lower than inventory costs for plastic bottles now because of rising costs, especially now with high inflation. And so as a result, when you have stuff that has been produced more recently on your inventory, it increases your inventory value. Because you have the latest stuff still in inventory, you're selling your older stuff first. This increases your inventory value. And on the other hand, you have last in, first out. So this is when you put the products from your inventory, it's flipped essentially. So you put the products that were in last, or that were in your inventory for the shortest period of time, on the shelves first. That's the stuff that you want to sell. So as soon as it comes in, it's like pretty much, hot off the press in your inventory, and you put it right on the shelf. And then you slowly make your way to the older, products within your inventory, but you try to sell the new ones first. So this leaves you, conversely with FIFO, it leaves you with your oldest products in inventory, and this thus decreases your inventory value. And so, I don't know if I have this written anywhere. Okay, we're gonna go into the next one. Hopefully I have it written. Yeah, so this matters to FP&A. And so what is the connection between all these concepts that are mainly treasury and accounting related to financial planning and analysis? Well, we need to know input costs when it comes into forecasting. If input costs go up, our forecasts and valuations are going to go a little bit down, and vice versa. So this matters to FP&A analysts because inventory value can and does drive net income levels and cash flow amounts when entering the balance sheet. So low inventory value, which is LIFO, because you still have your older, your older inventory with LIFO on still in your inventory because you're selling the newer stuff first. It means you have more expensive products in stock for sale. This increases your cost of goods sold. So if you look at the illustration over here, the input is basically, it goes 1, 2, 3. So 3 is the newest, 1 is the oldest. Let me actually write on here. This is a good one to write on. So this is the oldest, this is the newest. So for LIFO, you're selling the new one first, and you're selling the oldest one last. Here you're selling the oldest one first and the new one last. And so in your inventory, let's say you don't sell this. Let's say that your last unit doesn't sell, just your first two sell. Did not sell, and did not sell. So let's say those two didn't sell. What essentially happens is we know that in FIFO, 3, this is the newest unit. If it doesn't sell, that means this goes back to inventory. So for FIFO, our inventory value overall increases because our newest product went back into inventory because we sold our older products, which is the 1 and the 2. So that means that our COGS, or cost of goods sold, it decreases compared to LIFO because we sold our cheaper stuff first. So our cost of goods sold per unit is low. It also increases net income because remember, what does the income statement look like? It's revenue first, then COGS. And all else being equal, let's say SG&A is equal in both scenarios, tax and interest is equal. Tax obviously applies to your operating profit. But we're just going to take a look at gross profit here. So if your COGS goes down, that means your gross profit is going to go up. Because the thing that you're subtracting from revenue, if it's going down, then the difference goes up. And it's the same thing. If COGS goes up and it's more expensive, like the stuff that you sell is more expensive per unit, which is what happens under LIFO, then your gross profit goes down. So there's always a trade-off. You can either have more profits and higher taxes, or you can have less profits and lower taxes. So under the FIFO system, you have a higher gross profit because you're selling cheaper goods. What that means is you have higher net income. Higher net income under FIFO. Now that also means you have to pay higher taxes. That also means higher taxes. Oh, and then net income for LIFO, it decreases. But the good thing is, if you report lower net income, you also have to pay less in taxes. So with LIFO, you can actually save taxes. And for this reason, Congress, especially Democrats, over the past couple of decades, have actually been trying to ban LIFO because it's a convenient way for companies to understate their inventory amounts. Because they can just say that, oh, we don't have as much as in inventory, we're selling costly goods per unit. That's the stuff that we're putting on our shelves. And as a result, our cost of goods sold is up, our gross profit is down, as you see here. And as a result, our net income is down. So, if our net income is down, we either don't pay taxes if it becomes negative, or we pay less in taxes than we would have under the FIFO system. So, it's honest accounting. It falls within GAAP, or generally accepted accounting principles. There's nothing illegal about it, but it results in lost potential tax income for the government. And so they've been trying to crack down on it. They haven't really done it as much. There have been several hearings about whether or not to ban LIFO, but it still does exist. It's used extensively with companies that are looking to decrease their overall tax burden. But like I said, it's always up to the company. Do they want more profits, which is good for the shareholders? They look at the company, they look at the financials and say, oh, wow, you increased your profits. It might just be because they're employing FIFO, or it could be because their profits actually did go up organically. You also have to pay higher taxes on that. And if you make less profits or report less profits using LIFO, you don't have to pay as much in taxes. If anything, sometimes you could get negative profits by using LIFO and you don't have to pay any taxes. Or you can, you can request some sort of tax credit if you have a net loss. So yeah, that's FIFO and LIFO in a nutshell. once again, if you have any questions, let me know. I know it's a good amount of material, but I tried to narrow it down this week just to FIFO and LIFO and short-term working capital management. Okay, and the last thing I'm going to go over before I do my Excel demo is going to be risk and return. So the concept of risk and return in theory is very simple, but it goes very much in depth the more you go into finance, especially with regards to investment analysis and risk management within a firm. So risk and return are actually positively correlated. I don't know why it says inversely. Let me cross that out. So they're not inversely correlated, they're positively correlated. Changed that. Okay. That's the actual definition. So the more risk or volatility you take on in your investments, the greater potential and expected return. If I'm an investor and I'm looking to invest in a startup, it could be a tech company, it could be anything. And if it's very risky, if there's a lot of risk, if there's a lot of debt that the company is taking on, if there's a lot of instabilities within management, I expect a greater return. Because if I put my money into that type of situation, I want a higher return than if it was like a very safe company, if it was Microsoft. Because I know Microsoft. We all know Microsoft. They have very stable management. They have a strategy that makes them AAA rated in terms of debt, and very, very, they're trading at a high price to earnings ratio because they have the confidence of the market that being a company of the stature that they are going to return, they're going to provide a very good return to their investors. You can pretty much guarantee that you'll get some sort of return with Microsoft. But if it's a startup, that has a lot of debt, that doesn't have a track record at all, that has unstable management, why would I want to invest? Unless I get a higher return than I would for a less risky investment, like Microsoft, for example. So the more risk you take on, the greater the expected return. You should never take on a lot of risk for similar return for a less risky project, because you want to maximize your profits and your rate of return while also minimizing risk as possible. But this is the relationship that you have to always watch out for. More risk equals more return. And it's never inversely correlated. This is totally wrong. The goal of financial planning and investments is to maximize return while minimizing risk as optimally as possible. And this is kind of what I said. That's the goal here. But what makes it difficult is that risk and return are positively correlated. So theoretically, if you want to make a higher return, you have to take on more risk. However, there are situations where you can take on less risk or the same amount of risk and make a higher return. That's, that comes into portfolio analysis, project analysis, all that kind of stuff. And this is kind of illustrated within this graph over here. So you see the risk and return, they are positively correlated. They go up in a linear manner. The higher the risk, or as risk increases, so does return. And same thing. If risk decreases, so does return. Return is a function of risk, not the other way around. So risk is what you observe, and return is what you can deduce from that observation. Okay. Now we're going to look at an Excel example. So we're just going to take a look at a couple ratios over here. This is going to be a bit of review for all of you. So I just kind of want to gauge how well all of you kind of remember your income statement and your balance sheet and all that kind of stuff. So over here we have we have the income statement for 2021. So remember that we talked about, every income statement starts with revenue. Give me 1 sec. Okay. Every income statement starts with revenue. You deduct cost of goods sold, which is the cost of all the materials that you've sold, all those variable costs, and you get gross profit, or that's your profit after your variable costs. Once you get that, you do all of your expenses, or another word for that is SG&A, selling, general, and administrative. These are all the administrative costs depreciation, insurance, wages, all the kind of fixed costs. And then marketing and advertising also falls within SG&A. And there's some other costs that fall into that as well, such as amortization. Total all of those up, you get operating expenses. You deduct that from gross profit, or sorry, not operating. That's operating. That's marketing and advertising. You add those up, you get total expenses. 400 minus 300, 100 for your operating income. Tax rate is 35%. So 35% of 100, that's 35 bucks that you pay to the tax man every year, or sorry, for 2021. Payroll taxes, that's an additional 7%. So you pay $7 out of that 100, not out of the 65, but out of the full 100. So that's 7 bucks. And you're left with $42 that you have to pay in taxes. And as a result, 100 minus 42, you have $58 of net income. And if you want to distribute around 10% in owner dividends to your owners, you can do that. That's about $6. I rounded here. 20% would be double that, so it's $12. $17 in total share distributions and dividends paid out, and what you're left with is retained earnings of $41. So yeah, let's just do a couple financial ratios. If we don't get through all of them, because there's a lot more in the balance sheet. But for these, it should be pretty simple. And I actually have these ratios on the E column here as well, but let's just calculate them together as well. So gross margin, that's just gross profit divided by revenues. 400 divided by sales, 1100. That's around 36%. It's pretty healthy, but once again, all these numbers matter. It doesn't matter what the number is, even if it's 200%. Actually, that would never happen. You'd never get more gross profits than revenues. But even if it's at 80%, although that's really good, it could be bad if the industry average is 95%. So you never know. But in this case, it's 36. Operating margin, that's operating profit or income divided by revenue, about 9%. So there's a steep drop off. So what that tells us is there's a lot of SG&A, which makes sense. There's almost $250 worth of SG&A and $55 worth of marketing. So 5% of our revenues are going towards marketing. Sometimes that could be high, sometimes that could be low. Once again, we don't know because we don't have any comparisons. Net income margin, that is just your net income, not retained earnings. That's another measure. That goes back into your balance sheet. Your net income divided by your revenues, that's your net income margin, and that's 5%. So that's good. That means not a lot of cash outflows recurring between operating and net income. So you're not losing a lot to taxes and interest. And finally, the plowback ratio, this is a little bit different. That's why I want to put it here, along with the retained earnings, is the plowback ratio is how much of your retained earnings you are plowing back or you are reinvesting into the company. The opposite of this would be payout ratio. The opposite would be payout ratio, which is how much is paid out to shareholders. Plowback ratio is 1 minus that, essentially. And companies that are startups usually have high plowback ratios because they, plow back a lot of their earnings and they reinvest it into the companies, into the company for future growth. Whereas big cash cow companies like Microsoft or Apple, Google even, and even the utility companies that are publicly traded, they give out higher and higher dividends each year. They usually call themselves dividend aristocrats or dividend kings. Coke and Pepsi are great examples of this as well, because they are in the maturity phase. At that point, you don't need to reinvest your earnings as much. You just need to keep the shareholders happy. You are basically attracting investors for your dividend. Also because of the stock price, yes, but not really because of the growth. Your growth phase is over when you're a big company, when you're a cash cow. At that point, you just got to keep the investors happy. You got to keep the money coming in. So those companies have a low plowback ratio, whereas startup companies tend to have high plowback ratios. So let's calculate this. All right. So it's going to be 1 minus share distributions and dividends divided by your net income. And it's 70%. Now, if we want to do payout ratio, all we have to do is just 1 minus this. and it's 30%. That means this company is plowing back 70% of its earnings. What we can sense from that is there's a high chance that this company is a new one or it's a startup, and it's very growth oriented. It's taking 70% of its earnings and saying, all right, we're going to need 70% of this to keep growing. We're going to reinvest. 30%, they can be paid out to the owners in Class A or Class B shares, as well as the board members, shareholders, what have you. So they're reinvesting a large proportion of their earnings here. And that's what that 70% shows. All right. Now let's go on to the balance sheet. The first thing I want to show, hopefully this worked, is the retained earnings. So the retained earnings, it combines with the accumulated retained earnings with the 3,000. So you can assume that that 41 got combined with this 3,000 in order to balance out this balance sheet. Right? Liabilities and equity, 9,200. And I believe it's all in millions. Here it's Cola Company, but it has no relation to Coca-Cola. It's just a random company. And its assets are also 9,200. That green mark shows that it's balanced. If I were to change this even a little bit, it changes to red. That's what we don't want, because that's when it doesn't balance. That's when we have like more assets than liabilities and equity, or more liabilities and equity than assets, which doesn't make any sense, because assets are backed by either liabilities or equity and nothing else. So if you have more of one than the other, that means something is being financed by something that's not being taken into account here, or something is something is financing something else and is not being taken into account here. In that case, there's less assets. So I'm going to change this back. And now it's all balanced again. So there are a bunch of ratios here. I'm going to try to speed run it a little bit. I actually have kind of what each one of these ratios do and how to calculate them written in gray here, so we can do this pretty quickly. Working capital, that's pretty self-explanatory. That's how much in working capital that you have, how much in net assets. So once you get rid of your liabilities from your current assets, what is left over? So your net, working capital essentially. So we're going to go to current assets. So not total assets, we're going to current. So total current assets minus total current liabilities. 2,100, it's pretty decent. Considering all of our assets are 9,200, same as liabilities and equity, this is a pretty decent chunk. So I'd say the working capital as a percentage of total assets is about 23%. Pretty healthy, generally speaking, but once again, it all depends. Current ratio would just be assets over liabilities. Once again, current, not total. Total current divided by total current. There's a 1.89. Generally, you hear any current ratio above a 1 is good. That doesn't necessarily ring true. Their industry is where their current ratio, like they're so capital intensive, meaning they have so many more assets than liabilities, that their current ratio average could be over a 2, over a 3, sometimes even over a 5. Like, banks, for example, tend to have a lot of assets and not a lot. Sorry, no, banks are a bad example. Banks are the opposite. Banks have a lot of liabilities, so they have low current ratios. There are some companies that don't have a lot of liabilities. They need more money in equity, and they can't afford to get, debt. They can't afford to accrue debt. And there are industries like that as well. I can't think of any off the top of my head, but they have very high current ratios. So this 1.89, it's above 1. That could be good. That could be not as good. We don't know. But don't ever, fall for that BS, in my opinion, that a current ratio above a certain number is always good. That's not true. You always have to look at it in comparison with other companies and the industry in which this company is in. All right, moving on. Let's do debt to equity. That's total liabilities. Now we're not in current anymore. Now it's all of them. Total liabilities divided by shareholders' equity. So there's no total liabilities here. What we have to do is do total liabilities and equity minus equity. So we're left with liabilities only. And then we divide it by equity. So 0.63. So what this means is essentially there's less liability. So there's less liabilities than equity here. So this company relies more on equity for its sourcing of funds than it does liabilities. It could depend, why it does this. It could be the industry, it could be the way this firm is run. Some firms or some industries, such as the banking industry, they have very high debt to equity ratios. This one doesn't. All right, long-term debt to equity, same thing, but this time we're only doing long-term liabilities, which we actually do have, and we're doing it over shareholders' equity. This number is always going to be lower than total debt, obviously, because we're taking a subset of it. 21. Once again, we can't really come up with any conclusions about it, but it is a number to use. Total asset turnover, this is how quickly you're getting, you're selling stuff, how quickly you're making revenues relative to your assets that you have in order to garner those revenues. So revenues over total assets. We need to go back to our income statement for revenues, all the way up here. And then we divide it by total assets, which is here. Total asset turnover, that's 0.12. We don't usually convert this to percentage, so we keep it as a decimal point. Fixed asset turnover, pretty much the same thing, but we're using fixed assets instead of total assets here. So we're doing sales divided by total fixed assets. Where is it at? Okay. That's supposed to say, like, that 825 is supposed to say total fixed, not total assets. So yeah, because fixed assets is lower than total, this number is going to always be higher than total assets. Inventory turnover. This is cost of goods sold over total inventory. So this is how quickly you're getting rid of your inventory, basically how quickly you're turning it over, how quickly you're going through your inventory. And it can be used to calculate DPO, as well as receivables and payables for DRO and DPO, respectively. That's another way of calculating it. But inventory turnover is how quickly you go through your inventory in any given cycle. So we're going with cost of goods sold. This time we're going to use this number instead for COGS on the income statement and divide it by total inventory. And that's right here. So it's a 1-to-1 ratio. We don't know what that means. It just means that it goes like the inventory turnover within a year for this firm is 1-to-1 with cost of goods sold. So the inventory and COGS kind of moves in lockstep almost. Receivables turnover is revenues over accounts receivable. Once again, this is like how frequently and how often you are getting paid. So the higher this number is, the better. That means more of your revenues are turning into cash and less of it is being retained as AR. So this is 1.5. We don't know what that number means, but the higher this number, the better. Payables turnover, this is very similar. This is COGS over AP, because once again, all three of these are driven by the numerator. Inventory is driven by cost of goods sold. Accounts receivable is driven by revenues. The more revenues you get, the higher your receivable balance will be. And payables are driven by cost of goods sold. The more cost of goods sold you accrue, the more you'll have to pay in payables to your suppliers. So we're using cost of goods sold. We're dividing it by accounts payable somewhere here. Yeah, there it is. 1.17, it's above 1. Now these next three are easy. I can do them in like 5 seconds each, okay? All you have to do is 365, because there's 365 days in a year, over your receivables turnover for DRO. So that's a lot, 348. That means your receivables turnover is actually pretty high. The amount of times it gets turned over per year, the amount of times you get paid per year. DIO 365 over your inventory, that's going to stay 365 because the denominator is just 1. And then your DPO is 365 over your payables turnover. And that's how frequently you pay your suppliers and how quickly you pay them. Cash conversion efficiency or cash conversion cycle. Remember, this is DIO plus DRO minus DPO, as we said in the slides. You want your DIO and DRO to be low, and you want your DPO to be high. Clearly didn't happen here. DIO and DRO are actually pretty high here. DPO is actually also pretty high. but they all cancel each other out. So it's going to be a pretty mid-range number here. So we're going to do DRO plus DIO minus DPO. That's the cash conversion cycle. So what does this tell us? This basically tells us that for this firm, one cycle from reception of goods to inventory to finished goods to sales to collection of payments from customers takes longer than a year. Because 400 days, or that's longer than 365. So it takes more than a year on average for this firm to convert its its outflows into inflows and its inventory into cash, which can be a good thing. It also can be a bad thing. It depends purely based on the industry and based on the past of this company. This number could have gone lower. It could have gone higher. We don't know. And this could be the industry average. It could be below the industry average, which is good. And it could be above the industry average, which is not good. ROA, this is your net income over total assets. We're going to go all the way to the bottom to net income, divided by total assets. So your ROA is 0.63%, so it's less than 1%. I'm going to quickly do ROE now. So this is net income divided by shareholders' equity, just equity, not total, liabilities and equity. So here your ROE is 1.03%, just above 1%. Now these numbers seem pretty low, but once again, we don't know if these are industry average or not. And finally, net income over liabilities is going to be your return on debt. And for liabilities, we kind of need to do the same thing. We're going to do total liabilities and equity minus equity. And we get 1.63. And so what we see here is that the return on debt is the highest. The ROD is higher than the ROE or the ROA, meaning we're getting more bang for our buck in terms of how much we're spending in debt than we are in terms of how much we are spending on assets or spending on equity. And that's mainly because this company doesn't have as much debt as it does have assets or equity. So it makes perfect sense that this ROD number is higher than these numbers and that the ROE number is higher than assets, because the total assets are higher than total equity. All right, so that is my Excel demo. I can share this with you guys if you would like once this meeting is over. So I think we're pretty much at time. I said it'll be short, but we ended up going to the full hour anyway. I'm going to stop sharing. And I'm going to stop recording.